Annuities are one of the most misunderstood financial products in retirement planning. Some financial advisors push them on everyone, others say to avoid them completely. The truth is that certain types of annuities can be incredibly valuable in retirement, while others are expensive and unnecessary. Today, we are going to break down every major type of annuity, their true costs, and exactly when each one does or does not make sense. Welcome to the Retirement Classroom. If you are new here, we publish deep dive retirement education videos every week. Hit that subscribe button so you do not miss a single one. Before we get into the details, a quick note. This content is for educational purposes only and should not be considered individual financial guidance. Everyone's situation is different. Please consult with qualified financial professionals before making decisions. If you are looking to speak with a retirement professional about your unique situation, scan the QR code on screen or check the link in the description. Let us start with the simplest and often most useful type, the single premium immediate annuity, or SPIA. You give an insurance company a lump sum and they guarantee you a monthly income for life. In 2026, SPIA payout rates are at their highest levels in over 15 years. A 65-year-old male can expect roughly 7.3 to 7.8% annually per $100,000 invested. That means $100,000 generates approximately $610 to $650 per month, guaranteed for life. At age 70, the payout jumps to 8.4 to 9.1%, or roughly $700 to $760 per month per 100,000. A 75-year-old can receive even more. These rates reflect both the return on the insurance company's bond portfolio and the mortality credits you receive from risk pooling with other annuitants. The biggest advantage of a SPIA is simplicity and certainty. You know exactly how much you will receive every month for the rest of your life. The biggest disadvantage is that you give up access to the lump sum. Once you annuitize, that money is gone. Most SPIAs also do not adjust for inflation, which means your purchasing power declines every year. A fixed $1,000 monthly payment buys significantly less after 20 years of inflation. Next is the deferred income annuity, or DIA. This works like a SPIA, but you purchase it now and the income payments do not start until a future date, often 10 to 20 years later. Because the insurance company has your money longer and some purchasers will die before payments begin, the payout rates are substantially higher. A DIA purchased at 60 with income starting at 80 can provide remarkably high monthly payments. DIAs are sometimes called longevity insurance because they specifically protect against the risk of living a very long time and running out of money. The Qualified Longevity Annuity Contract, or QLAC, is a special type of DIA that can be purchased within a traditional IRA or 401k. Under Secure Act 2.0, you can now invest up to $210,000 per individual in a QLAC as of 2026. The key tax advantage is that QLAC funds are excluded from your required minimum distribution calculation. This means if you have a $1 million IRA and put $210,000 into a QLAC, your RMDs are calculated on only $790,000. The income payments from the QLAC must begin by age 85 but can start earlier. For retirees who want to reduce their RMD burden while securing guaranteed income for advanced age, the QLAC can be an excellent tool. Now let us talk about fixed annuities. A fixed annuity works like a certificate of deposit issued by an insurance company. You deposit money and earn a guaranteed interest rate for a set period, typically 3 to 7 years. The rate is usually slightly higher than comparable bank CDs because the insurance company is not FDIC insured, though annuities are backed by state guarantee associations, typically up to $250,000 to $300,000, depending on the state. Fixed annuities grow tax-deferred, meaning you do not pay taxes on the interest until you withdraw it. This makes them potentially useful for accumulating retirement savings in a tax-efficient way. Fixed indexed annuities are more complex. Your returns are linked to a market index like the S&P 500, but you do not actually invest in the market. Instead, the insurance company credits interest based on the index performance, subject to caps, floors, and participation rates. The floor is typically 0%, meaning you cannot lose money in a down market. But the cap might limit your upside to 6 or 8% even if the index returns 20%. The participation rate might credit you only 60 to 80% of the index gain. After accounting for caps, participation rates, and the exclusion of dividends, the effective return on a fixed indexed annuity typically falls between 3 and 6%, significantly less than actual stock market returns. Variable annuities are the most expensive and controversial type. A variable annuity lets you invest in sub-accounts similar to mutual funds, with your returns depending on market performance. The insurance wrapper provides tax-deferred growth and optional guaranteed income riders. The problem is the fees. The average variable annuity charges 2.3 to 2.5% annually. This includes a mortality and expense charge of 1 to 1.5%, fund management fees of 0.5 to 1%, and administrative fees. If you add a guaranteed lifetime withdrawal benefit rider, which is the feature that makes variable annuities most attractive, that adds another 0.75 to 1.25%. Total all-in costs can reach 3.5% or more. At 3.5% annual fees, you need the market to return at least 7% just to match a basic stock index fund, returning 3.5% after fees. Now let us talk about when annuities actually make sense. Academic research from Moshe Milevsky and Wade Pfau suggests that partial annuitization of 25 to 50% of your portfolio is optimal for most retirees. The key word is partial. You are not putting everything into an annuity. You are securing a guaranteed income floor to cover essential expenses, then investing the rest for growth and flexibility. Annuities make sense when you have a longevity risk, meaning your family tends to live into their 90s or beyond. They make sense when you have an income gap, meaning Social Security and any pension do not cover your essential expenses. They make sense when you are age 70 or older with good health because the mortality credits become more valuable as you age. And they make sense when you want to reduce anxiety about market volatility by having a guaranteed paycheck regardless of what stocks do. Annuities do not make sense when you have more than enough guaranteed income from Social Security and pensions to cover essentials. They do not make sense when you have a terminal illness or significantly reduced life expectancy because you will not live long enough to benefit from the mortality credits. They do not make sense when the fees are excessive, which is a particular concern with variable and index products. And they do not make sense when you need full liquidity because most annuity products lock up your capital or impose surrender charges. Let us talk about taxes. For annuities purchased with pre-tax money inside an IRA or 401k, all income payments are taxed as ordinary income, the same as any other IRA distribution. For annuities purchased with after-tax money outside of retirement accounts, each payment is split into a tax-free return of principal and a taxable earnings portion using what is called the exclusion ratio. The IRS determines this ratio based on your investment and expected return, and it is outlined in IRS Publication 575. When evaluating any annuity, insist on these standards. The insurance company should have an AM Best rating of a minus or better. Understand every fee in writing before you sign. Compare quotes from at least 3 different companies. Never annuitize more than 25 to 50% of your total portfolio. And be very skeptical of any product with surrender charges longer than 7 years. Here are the key takeaways. SPIAs offer the highest guaranteed income per dollar invested. 2026 payout rates are the best in 15 years. QLACs reduce your RMD burden and guarantee income in advanced age. The 2026 limit is $210,000 per individual. Fixed annuities work like tax-deferred CDs, simple and low cost. Fixed indexed annuities have hidden limits, caps, participation rates, and no dividends reduce effective returns to 3 to 6%. Variable annuities average 2.3 to 2.5% in fees. Add riders and costs can exceed 3.5%. Partial annuitization of 25 to 50% is the academic consensus for optimal allocation. Only use an insurance company rated AM Best A minus or better. Annuities make the most sense for retirees with longevity risk and an income gap after Social Security. If this breakdown helped you understand annuities, hit that subscribe button and turn on notifications so you do not miss our next deep dive. We publish new retirement education every week.
Hey, before you go, if you're serious about your retirement, we'd love to help. Scan the QR code on screen right now or visit the link in the description to book a completely free strategy session with a qualified professional. It only takes a couple minutes to fill out, and there's absolutely no obligation. Take the first step today. We'll see you in the next one.